2 weeks ago, we called it a kinetic trap. Today, that trap has snapped shut, but nobody pulled the trigger. Welcome back to Market Lens. I'm Daniel Reed. It is Tuesday, May 19th, 2026. Over the weekend, President Trump called off what he described as a scheduled strike on Iran. He said, and I quote, "Serious negotiations are now taking place." Brent crude spiked above $110 on the headline, then retreated as markets priced in the pause. But here is the logic the mainstream is missing. A pause is not a peace, and the market is already rotating ahead of the next move. Today, the S&P 500 is down 0.7% at 7,350. The Nasdaq is off 1.3%. Small caps are getting crushed. The Russell 2000 is down nearly 2%. The only thing green on my screen? Energy and the dollar. This is not a panic. This is a repositioning. The market is selling what worked in April, AI infrastructure, and buying what works in a negotiation scenario, energy, utilities, and hard assets. Let's start with the headline that moved the tape. Trump called off the strike. On the surface, this is bullish. De-escalation is good for risk assets. Oil falls, inflation fears ease, the Fed gains room to cut. That's the soft landing narrative. But look closer. The president's exact words were that he called it off because serious negotiations are underway. Not because a deal is signed, not because Iran backed down, because talks are happening. This is the fragile pause, a ceasefire in all but name, where both sides posture while diplomats scramble. The market hates uncertainty more than it hates conflict. A clean strike and a clean response is predictable. This gray zone, will they, won't they, is what keeps the VIX elevated at 18 and the 10-year yield above 4.6%. The bond market is telling you something important. The 10-year at 4.6% is not a soft landing yield. That is a growth plus inflation premium. The bond vigilantes are not convinced this pause leads to peace. They are hedging for a restart. Smart money takeaway: do not buy the pause as a permanent resolution. This is a volatility event, not a volatility end. Now let's talk about where the pain is concentrated. Technology. The Nasdaq is down 1.3% today. But that headline masks the real story. AI infrastructure stocks, the names that doubled and tripled over the past 2 months, are getting hit hard. Seagate is down 10% this week after issuing cautious guidance. Hyperscalers like Amazon, Meta, and Tesla are off up to 2%. This is a positioning washout. The rally in AI infrastructure was fueled by speculative long positioning following bumper earnings from the hyperscalers. When Seagate, a bellwether for data center demand, signals caution, those crowded longs unwind fast. But here is the critical distinction. This is not a AI bubble burst. This is a rotation. The money leaving AI infrastructure is rotating into the beneficiaries of AI demand, specifically the power and utility sector. Which brings us to the biggest story of the week. NextEra Energy is acquiring Dominion Energy in an all-stock deal valued at $67 billion, the largest merger in power sector history. Read the press release carefully. NextEra's CEO John Ketchum said, and I quote, "Electricity demand is rising faster than it has in decades. Scale matters more than ever." This is not a utility merger. This is an AI infrastructure play disguised as a power deal. Data centers are going to consume 15 to 20% of all U.S. electricity by 2030. The companies that own the grid will own the bottleneck. The combined entity will serve 10 million customers across Florida, Virginia, the Carolinas, exactly the regions where AI data centers are being built at record pace. This is the smartest capital allocation trade of 2026 so far. Dominion shareholders get 25.5% of the combined company. NextEra gets 74.5%, and full control of the AI-driven demand thesis. This is the electricity supercycle trade in action. If you own tech but not power, you are not hedged for what comes next. All of this sets the stage for Wednesday. Nvidia reports Q1 earnings. This is the most important earnings report of 2026, period. Nvidia is not just a stock, it is a proxy for the entire AI thesis. If Nvidia guides higher, the AI infrastructure rotation pauses, but the broader bull case stays intact. If Nvidia disappoints, the correction accelerates. The whisper number is 92 cents EPS on $42 billion in revenue. The options market is pricing a 9% move in either direction. That is a $250 billion swing in market cap. My framework. Nvidia will beat and guide conservatively. The demand is real. Every hyperscaler, every AI startup, every government defense contract runs on Nvidia silicon. But the guidance will be measured because the supply chain is still constrained and geopolitical uncertainty makes forecasting impossible. The trade. Buy the dip if we get a post-earnings sell-off. The AI thesis is intact. The rotation out of AI infrastructure is healthy. It shakes out weak hands before the next leg up. Let's zoom out. Oil is at $100. The 10-year is at 4.6%. The VIX is at 18, and the Fed is stuck. If oil stays at $100, headline inflation stays sticky. If inflation stays sticky, the Fed cannot cut. If the Fed cannot cut, growth stocks get re-rated lower. This is the Fed trap we have been warning about since April. The April CPI print came in at 3.8%, hot enough to keep the Fed on hold. The jobs market added 115,000 positions, strong enough that the Fed has hawkish permission to wait. The only way out of this trap is a genuine Iran deal that crashes oil back to $80. That is scenario A, the sudden signature we outlined 2 weeks ago. It is still on the table, but it is not the base case. Scenario B, the fragile pause, is playing out exactly as we predicted. Oil stays elevated but not spiking. The market grinds sideways. Tech corrects. Energy and utilities rally. Small caps suffer. The playbook for this environment: own the bottlenecks, power grids, energy infrastructure, defense AI. Own what the government and the data centers must buy, regardless of what the Fed does. The 2026 market is not complicated if you understand the modal shift. We have moved from a rate-driven market to a resource-driven market. The winners are not companies with low debt. They are companies that own something scarce. Scarce compute, scarce power, scarce energy. Nvidia earnings tomorrow will determine the near-term direction, but the fragile pause framework remains our base case. Volatile, rotational, and unforgiving to leverage. Stay disciplined. Watch the 10-year, watch oil, and watch what the utilities CEOs do with their balance sheets. They see the future more clearly than any analyst. I'm Daniel Reed. This has been Market Lens. Subscribe for our Nvidia earnings special tomorrow morning. We'll be live 30 minutes after the print.